What is the fundamental mistake many investors make? How can you keep from selling stocks during a bear market? And how can the Wall Street Journal wreck your portfolio? We'll answer these questions and more on this, the 23rd episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey everybody, welcome to day 16 of the 31-day money challenge. Yesterday we had Carl Richards on the show to kick off several days on the important topic of investing. If you've listened to that show, you know that he's an author of an excellent book. He's a certified financial planner, and he's written a book called The Behavior Gap: Simple Ways to Stop Doing Dumb Things with Money. And really, at the core of that book is the idea that folks tend to buy high and sell low. And what that means is that as the stock market heats up and the prices of stocks go up, people start to feel comfortable again about investing in stocks. And so they tend to move into the market as the market is rising, and it's really the wrong time to make that decision, because what inevitably happens is that eventually the market goes in cycles. It will fall again. It will have a downturn, and then of course people then get scared. You know, they're worried about their future. They're worried about their investments, retiring, saving for a child's education, and they see their portfolio balance, losing money day in and day out. You can basically hit the refresh button on your browser and see that you've got a lower balance, and it scares people. That's understandable, and so out of that fear they sell, and they kind of repeat this cycle, and that's effectively what Carl calls the behavior gap. And so I thought it would be a good transition to today to talk about how we can avoid that. You know, it's easy for the experts to say, you shouldn't buy high or sell low. Well, that's great, but walk in my shoes for a minute. I'm trying to retire here, and I look at my balance. It's not easy to stay with your investment plan, to stay with your asset allocation plan when the market, is heading down 30, 40, 50%, in 1 year. And so, that all this advice is just, terrific, but what good's it going to do me? How do I keep myself from making these bad decisions? And so today I want to give you some practical tips on how you can do that, at least how I've been able to do it. And I'm actually going to start all of that with a little bit of a story. But before we get to that, let me first introduce you to our two sponsors for the 31-Day Money Challenge. They're really have been what's made this 31-Day Money Challenge possible. The first is Betterment. It's an online platform that invests your money for you in stocks and bonds. You just pick the percentage you want in each, and Betterment then invests your money in low-cost ETFs. They also are kind enough to rebalance your portfolio for you and to reinvest your dividends automatically. You can check them out at betterment.com. And our second sponsor is Personal Capital. It's a free online tool. You can connect all of your investment accounts, retirement and non-retirement, and it will show you how all of your investments are doing, your performance. It'll show you your asset allocation across all of your investments. It'll also show you what your investments are costing you, including what your 401k is costing you. You can check Personal Capital out at personalcapital.com. So what is the fundamental mistake that investors make? We've talked about it. We talked about it yesterday with Carl. It's that whole buying high and selling low. In some cases, it's chasing hot stocks. Last year, one of the hot stocks was Tesla, the electric car company. That stock just started going up, and it kept going up. And it got to the point where even the owner, or the principal owner of that company said, hey, this is crazy. Our company's just not worth the valuations we're seeing in the market. And so as investors, the question is, all right, fine. We know we shouldn't buy high, and we know we shouldn't sell low. We shouldn't trade out of fear or greed, right? So, okay, how do we keep from doing that? And I have a handful of tips to help you do that. But before we get to them, I want to tell you a story. And I want to see what you would do. I'm going to compare two companies for you, and I want to see which one you'd buy. If you had to buy one of them, which one would you pick? And underneath this story, really the principle is this. I think most investors make fundamental mistakes because they do not invest like a business owner. And when you buy stock in a company, whether it's an individual company or you invest in a mutual fund that has stock in hundreds of companies, you are a business owner. That's what you are, and you have a stake in this company or companies that you're investing in. But I think far too often we don't think like a business owner. It's almost like a game. You can log into your account, see what's happening, trade this, trade that, buy this, and I think the sort of financial news industry perpetuates this in ways that are very, very unhelpful. And so I want to try to convince you today of the importance of thinking like a business owner. So to do that, to start with, I want to tell you a story. Imagine you were going to invest in a company. You weren't going to buy stocks, though. You were going to just buy the whole company, kind of like Warren Buffett does at Berkshire. He buys whole companies, right? He bought Geico. He bought Dairy Queen. He bought a railroad. He buys whole companies. So we're going to imagine you're going to do the same thing, and you've hired a broker to help you find a company to buy. You want to buy one, and you're not particularly concerned about the industry. You're not going to actually run it day to day. You're just going to buy it and either keep management that's there or install new management. You're going to have other folks run it for you. So you hire this broker, and he goes out and he comes back and he tells you, well, we got two companies I think are worth considering. And you say, that's terrific. What are they? Tell me about it. He goes, well, one's a trucking company. All right, good. And one's a drugstore. All right, well, two very different industries. Fine, good. And he tells you, and they're both for sale for the same price. They both are asking $1 million. Oh, okay, good. Well, what else can you tell me? He stops there, goes, well, that's all I've got. That's all you really need to know. Trucking company to drugstore, they're both same price, $1 million. Which one do you want to buy? Now, at this point, I'd probably fire the broker. What do you mean, which one do I want to buy? How would I know that? I don't know how much they make. I don't know what their expenses are. I don't know how what their earnings are. I don't know what their balance sheet looks like. What do you mean, which one do I want to buy? And he looks at you with this sort of odd look. He goes, I don't understand. I've been in this business a long time, and all of my clients, I tell them the company and the asking price, they just make a decision. Now, as we think about it in terms of buying a whole company, that kind of thinking is just absurd. Yet it's exactly how people invest in stocks all the time. I mean, just imagine the frenzy around Facebook when it went public. Do you think that all of the people that bought stock in Facebook had actually read the company's 10K? In fact, I'm guessing a lot of people who invested in Facebook didn't even know what a 10K was or its filings to go public. And if you're saying, well, what is a 10K? It's a company's annual report that they file with the SEC. It includes their audited financial statements. It's a Form 10K. They also file those on a quarterly basis called 10Qs. If they have a big event in between a Q and a K, they file an 8K. But people do it all the time. I've talked to them. They buy the hot company, they buy the Tesla. They have no clue how much the company's making. Or what their revenue is, what their expenses are, what their balance sheet is. They have no idea. They've never read the financial statements. And it just underscores that while it may seem silly to do this, if you were going to actually go out in your community and buy a company, you'd never think that way. Folks do it all the time in the stock market. And if you're even for folks in mutual funds where you're not going to, mutual fund invests in, say, 500 companies, you're not going to obviously analyze all 500 companies. But I'll talk to people and say, oh, you've invested in such and such a mutual fund. Okay, what's its asset class? They have no idea. Maybe they'll know it's U.S. companies. Oh, is it big companies, small companies? They don't have a clue. What's it cost? What's the expense ratio? How much do you have to pay to invest in this mutual fund? No idea. So as silly as it sounds when we talk about it in the context of buying, a real company, right? A local company that you're going to actually own outright. People do it all the time in the stock market. So let's continue on our example, and we tell the broker, look, that's ridiculous. We're not going to make a decision based on price. That's insane. So go back to the trucking company, go back to the drugstore. We want some financial numbers. So he does, comes back, goes, I got the numbers for you. And he says, look, it's early 2014. They don't have their financial statements for 2013 wrapped up yet. We'll obviously can get those before a decision is made, but I've got their 2012 numbers. Fine, I get that. No worries. He goes, all right, well, for the trucking company, its revenue was $9,875. And you just stare at them. You say, well, it's revenue, 9,000. Was that its daily revenue in 2012? Oh, no. That was its total revenue for all of 2012. And you think, wait a minute, this is a company that's asking $1 million, and its total revenue for an entire year was less than 10,000? Yes, that's right. And you almost hate to ask, but you're going to do it anyway. All right, well, what were its expenses? Well, its expenses were actually more than its revenue, $12,312 for a total loss in 2012 of $2,437. And at this point, you'd probably fire them again. I'm going to pay $1 million for a company that has revenue of less than 10,000 and actually loses money? Maybe we could talk about the drugstore. Okay, well, that one's a little better. Its revenue was $1,129,468. Oh, okay, now we're talking. But how about its expenses? Did this one lose money too? No, made a profit. Expenses were about $957,000 for a profit of $172,000. Wow. Okay, let's start to think. Well, if I pay $1 million for that, I don't know if I can keep earning 172. I'm going to need to study the company a lot more to see, trends and that sort of thing. But I'll get my money back in earnings in six years or so. All right, that's not bad. And then you start to wonder, well, why in the world is he even bringing the trucking company to me? It's just ridiculous. But, you do want to look at the balance sheet. So you ask him about the assets and the net worth. So let's go back to this trucking company. Who knows? Maybe it's got an incredible balance sheet. So what are the total assets of this trucking company? He tells you $25,968. It's like it just goes from bad to worse, really. And its net worth, $19,500. $19,500, and they want $1 million. Did you ask them why in the world they thought they could get $1 million? Oh, I sure did. And they believe in this company. They think it's just going to go right through the roof like a monkey out of a box. Okay. Well, if they think that about their company, why are they selling? Well, they've got investors. They need to exit, blah, 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 blah. All right. You're done with the trucking company. What about the drugstore? Well, it's got total assets of about $1.7 million, $1,758,281, and a total net worth of $213,815. Now, at this point, you're obviously going to do more due diligence, but the trucking company is out, and the drugstore is something you might take a closer look at. Now, I appreciate your patience as I've gone through this story. You may at this point be wondering, it's kind of a ridiculous comparison, Rob. The numbers are so far apart. Obviously, no one would buy the trucking company. Shouldn't you have come up with an example that maybe, was a little tougher of a call? Well, you also may be asking yourself, the numbers I gave you were awfully specific. Did I just make those up? I didn't. I actually took two real companies, both of which you've no doubt heard of. Of course, I changed the ratio of the numbers, right? The real life companies, which I'll tell you about in a minute, aren't valued at $1 million. Actually, they're both valued at about $32 to $33 billion. And I simply took the ratio between their market valuation and their revenue, their market valuation and their expenses, and their loss or profit, and their assets and their net worth. It's an exact one for one. Just brought it all down to $1 million, so that we could kind of feel the numbers. It's hard to kind of wrap your mind around $32 billion. But the ratio between their asking price and their revenue and their total assets and their net worth and everything else, exactly the same. So what are those two companies? Well, the trucking company, I thought that I would be cute, right? Trucking is Twitter. The drugstore, Deere & Company, otherwise known as John Deere. Nothing runs like a deer. And I watch these two companies closely. I have not invested in either. I've given serious consideration to investing in Deere & Company, but I haven't at this point. I would never invest in Twitter at its current valuations. But I wanted to underscore this notion that the market gets crazy sometimes. Why in the world, with limited capital, or for that matter, unlimited capital, would you invest in a company at that kind of price that's losing money? Now, I understand the argument's going to be, well, Twitter's the hot thing, and it could grow. It could. I suppose anything could happen. But the market price, the asking price, is totally divorced from the fundamentals of the company. Now, what makes this hard for some folks is that you can actually invest in Twitter and make money. People have done it, right? Day traders, short-term traders. They jump in. They don't read the financial statements because they don't care about the financial statements. They're just hoping that the market bids up the price, and in a day or a week or maybe a month, they'll sell. And some will make money that way, and you'll no doubt hear from them. If you know them, they'll be telling you their stories. They'll never tell you they're losers, but they'll certainly tell you the winners. But this is an example of a company whose market price, its valuation, is divorced from the reality of the company. Now, my comments here have nothing to do with Twitter as a company, but rather Twitter as an investment at its current price. The same is true with Deere & Company. And it underscores what I think is, as I said, an important aspect of investing. You need to think like a business owner. And a business owner, you're going to want to know revenue. You're going to want to know expenses. You're going to want to look at a company and ask, can I run it more efficiently if I were to buy it? Can I expand its markets? Can I grow its top line, right, its revenue? Can I grow its bottom line by shrinking expenses and still being efficient and still being productive? And you're going to ask, all of these questions. But at the end of the day, what's going to matter to you are earnings. What kind of money is this company, this asset going to produce for me? And are those earnings worth the asking price? That's going to be the question for you. If you're running your own business or buying it in whole and having someone else run it, that's going to be your question. And I think that should be your question as an investor. I can tell you, having gone to the Berkshire Hathaway shareholder meeting this past year and listened to Warren Buffett and Charlie Munger, I can tell you that's exactly how they think. They wouldn't invest in Twitter ever at its current valuations, maybe ever, but certainly at its current valuations. And again, it's not a criticism of Twitter as a company, but it's rather looking at Twitter as an investment, and we need to separate those two things out. It may be a fun company, you may like the technology, but as an investor, ultimately your question is, what kind of earnings will this asset, this company, generate? And so with that story, I want to get more specific because, you may say, look, Rob, that's terrific. I'm glad you looked those numbers up, fun story, whatever. But how does that help me as an investor? How can this help me invest better over the long term? And really, for me, it's the key of how can you keep from buying low and selling high? And by the way, you may be thinking, well, wait a minute, should you be buying or selling at all? I thought the idea was you invest and it's for the long term and just leave it there. But remember, even with an asset allocation plan, you're rebalancing. And so it causes you, when say stocks go up like they did in 2013, to rebalance, you've got to sell stocks and buy bonds. Of course, when the stock market's up like that and bonds are where they are, you start to read a lot of financial news and everyone tries to talk you out of that, saying, oh, well, bonds are expensive and, all that sort of thing. It gets really hard. Buying low and selling high is not easy. And so I want to give you some tips to help you do that. And the first one kind of relates to the story I told you, and that is that in the long term, the price of stocks follow earnings. I mean, there's certainly at times investors are willing to pay a little more or a little less for earnings, right? That's the price-earnings ratio. It can move up and down as the markets heat up or cool off. But over the long term, the value of the stock market or the value of an individual stock is going to follow earnings. Now, in the short term, it's not necessarily. Just look at Twitter. In the short term, all kinds of craziness can happen. I mean, all kinds of things can affect the price of stocks. That's why one of the things that Buffett says is that in the short term, the market is a voting machine, and in the long term, it's a weighing machine. And what he means by that is that in the short term, it can often be the stocks that are popular. Again, Twitter, Facebook, Tesla, that go to extreme highs, and companies that are less popular, like Deere & Company. I mean, who's out there talking about John Deere? People are talking about Twitter. It gets forgotten, so in the short term, the market can be a voting machine, but in the long term, it is a weighing machine. In the long term, it's going to reward those companies that are earning, that have their earnings. They're growing their earnings. They're solid earnings. They're consistent. And moving upward. That's what the market is going to reward in the long term. The problem is it's very difficult to think long term, particularly with the financial news. So the first thing I would say in trying to buy low and sell high, to avoid market timing, to avoid selling out of fear or buying out of greed, is to remember that in the long term, the market follows earnings. That's the way it's worked. You can look at charts of individual companies. You can look at charts of an index like the S&P 500. And in the long term, that's what it's going to follow. So that's point one. The second point is this: you have to have a plan and you have to stick to it. And we're going to be talking about asset allocation plan and how to create one. Tomorrow, I've got an interview with Larry Swedroe, who's an excellent author on investing topics. I think you'll enjoy that interview. The following day, we're going to dive right into how to create an asset allocation plan. But if you don't have a plan, then you're going to be guided by other things. Again, you're going to be guided by the financial news, what the markets are doing. You need an asset allocation plan, and the good news is they're very, very easy to create. It may seem intimidating, overwhelming. It shouldn't be. They're very, very easy to create. We're going to walk through that 2 days from now. Now, I will say one thing about asset allocation plans and planning in general. I was talking to a retired general the other day, and he made the comment. He said, I guess I've never served in the military, but apparently if you have, this will be familiar to you, and that is, no plan survives first contact. And what that means is, you plan going into battle, but once you engage the enemy, plans get thrown out the window because the enemy has plans of their own. And it's just difficult, if not impossible, to predict how things are going to go once you have first contact. Mike Tyson actually, of all people, had the same. He expressed the same idea when he said, "Everyone has a plan until they get punched in the face." Right? Well, it's true with investors as well. Everyone has a plan until the stock market drops 40%. So we need a plan, but we also need the resolve to stick with it. We need to stick with it after we get punched in the face. And trust me, if you're going to invest for the long haul, there will be days, weeks, months, years when you feel like you've just been punched in the face. You don't have to look back too far to see that, say 2008 and 2009 when the market was down. So that brings me to the third point, the most important asset allocation decision we'll talk about and that you have to make is the allocation between stocks and bonds. That decision is what's going to drive how much your portfolio goes up in a good year and how much it goes down in a bad year. And we're going to talk about how you can figure out, at least based on historical data, a rough idea of, for example, if you have a 50-50 split, what are the likely outcomes in a good year and a bad year? Or if you have, say, a 70% stocks and 80% bonds, again, what you're likely to see in a good year and what you're likely to lose in a bad year. But that's an important decision, and it's important both in terms of understanding the kind of risk you're willing to take. Can you really have a, say, 80% stocks and 20% bonds and resist the temptation to sell when the market is down 45%? So we're going to talk about that at length as we cover asset allocation. The other thing that's important in terms of your stock versus bond allocation, it's not just a matter of can you stick with your plan during the bad times, but it's also important in understanding what kind of returns you're likely to see in your portfolio over the long term. We can't predict with certainty, but we can get a rough idea. And so many people, when they talk about risk in the stock market, what they're referring to is volatility. Stocks are riskier than bonds because they go up more and they go down more than bonds do. And that's an important consideration. But, it's not the only risk as investors that we face. One other risk, I would say a bigger risk, is not having enough money in retirement. But we oftentimes don't think of risk that way. We just think of the volatility of an investment, or put another way, the risk that your capital that you're investing, the goal of investing really is to invest in such a way that you have a reasonable chance of growing the purchasing power of your capital. In other words, that you have returns that exceed the rate of inflation. But we oftentimes don't think of risk that way. We just get concerned about the ups and downs of the market. It's important, but it's not the only risk. So that's the third point here. We've got to get the stock versus bond mix correct. There's no one answer. And that's important to understand. There's no one answer to that question, because part of it depends on what you can stomach. So that, again, we'll cover that 2 days from now when we talk about asset allocation plan. But getting that right goes a long way to enabling you to stick to your investment plan. The fourth way that I find is helpful in sticking to a plan and avoiding, buying high and selling low, is to favor index funds. And so, an index fund, you can imagine two different kinds of mutual funds. One where there's a manager that actually evaluates companies and picks stocks to invest in, as opposed to an index fund that simply buys stocks to track a certain index, like the S&P 500 index. There's no one making decisions about which companies they think will be winners and which companies will be losers. It's simply through a computer program invests in the companies that make up the S&P 500 index. And I think favoring index funds is important important for a couple of reasons. The first is if you don't have a manager actually picking stocks, then when the fund is down, and it'll be down a lot because that's the nature of investing in stocks. It's not because of human error. You know that the reason it's down is not because some fund manager has lost his or her touch or that they've made horrible investment decisions on your behalf. It's down because that index is down, because the market is down. Now, that's hard enough to deal with. But if you add to that the concern that maybe a fund manager is making bad decisions, then it really gets hard to stick to your investments. And so, and in fact, it's one of the reasons that I left most actively managed index funds. I invested in a fund run by Bill Miller, Legg Mason Value Trust, which beat the S&P 500 for, I think it was more than a decade. It was an incredible run. And during that run, I just came to the conclusion, I said, this is going to end someday. I have no idea when, but it's going to end someday. And am I going to be able to stick to this investment when it does? And I concluded I wasn't. So while it was still beating the S&P 500, I actually sold it and moved into index funds. And a couple of years later, it crashed. And the fund, took a nosedive. And I think Bill Miller is a fabulous investor. I mean, a very knowledgeable man. He did very, very well, but actively managed funds rarely beat the S&P 500 over the long term. So that's the one aspect of index funds. The other one is because they have such low fees. If you're paying 1% for a mutual fund and it starts to do poorly, I think it's another reason that you might think, I need to sell. Not only is my fund not doing well, but I'm paying 1%. I see this Vanguard S&P 500 index fund I can get for 7 or 10 basis points. That's just a fraction of 1%. And so I think by buying low-fee index funds, both because they don't have managers that could be making bad decisions and because they're not charging you an arm and a leg, you're more likely to stick to those investments in bad markets. I know I am. All right, so the fifth and final sort of tip I want to give you in terms of how do you stick to your plans, how do you stick to that asset allocation plan during good times and bad is to, I'll put it in the extreme, ignore the financial media. Now, it's hard to do, so I'll say it maybe differently. Separate fact from opinion in the financial markets, in the financial news. And I want to give you an example. And I pick on the Wall Street Journal in part because I think it's a wonderful newspaper. I get it every day and I read it. But, you can read the Wall Street Journal and get some really, I think, bad reporting. And I'm looking at an article that came out earlier this week. The title is Market Pause Binds Buyers. And then there's a subtitle. Unusual drop in stocks reflects unease, but nobody wants to miss out on gains. It just drives me crazy when I read that. Let's just tear this apart. Unusual drop in stocks. That's false. There's absolutely nothing unusual about the decline in the market in the first few days of 2014. It's happened over and over and over and over and over again for decades and decades and decades and decades and centuries. Nothing unusual about it. In fact, if you were going to say there was anything unusual about it, it is that it hasn't dropped more. But it's not. There's nothing unusual about the fact that the stock market is down. Nothing. In my short 20 plus years of investing, I've seen this countless times, and it'll happen again and again and again. In fact, the market will be down a heck of a lot more than it's been down so far in 2014. There ain't nothing unusual about it. Sorry, Wall Street Journal. Unusual drop in stocks reflects unease. I always like that. How do they know that? I mean, did they survey 1,000 investors? I don't feel uneasy. Do you? I don't know. Apparently they've talked to someone and they've decided that the market is down because people are uneasy, I guess. I don't know how they reached that conclusion. I'm not uneasy. In fact, the thing that makes me the uneasiest, if that's a word, is when the stock market is flying high. That's when I get nervous. He goes on, but nobody wants to miss out on gains. Well, I suppose that's true. I don't want to miss out on gains. Who wants to miss out on gains? But again, we don't know when the gains are coming in terms of the market ups and downs. We have no idea. We don't have any idea what 2014 is going to look like. No one had any idea what 2013 was going to look like. Now, people are predicting all the time. So every year they get all the quote unquote experts and they make a gazillion predictions. And at the end of the year, they go back and they pick the 3 that got it right. And they repeat over and over and over again. I always like how they try to support the credentials of some. Well, they predicted the housing crash in 2008 and they correctly. They did. People are predicting things all the time, and some of them will occasionally get it right. Will they always get it right? Nope. I ignore the predictions. They're pointless. Now, let me just got to read another paragraph or so into this article. After a roaring 2013, the stock market is starting 2014 with a whimper. Well, I mean, I guess that's okay. The uncharacteristic dip, there ain't nothing uncharacteristic about it, but let's keep going. The uncharacteristic dip is leaving investors in a tough position. Selling now could protect them from future declines, but also could mean they would miss out on the gains most experts are still forecasting for stocks this year. This is the kind of news story in a well-respected newspaper that you just need to ignore. It's the kind of thing that I think can tempt people to do dumb things with their money. We go right back to Carl Richards and the behavior gap. It's reading this kind of stuff in a well-respected newspaper and then starting to get worried. Oh my goodness, that dip is uncharacteristic. This is an unusual drop in stocks. What should I do? You shouldn't do anything. You should have an asset allocation plan and you should stick to it. Well, that's my opinion anyway. You've really got to watch what you read in the financial news, and you need to read everything with a grain of salt, particularly when it comes to predictions, characterizing the market as, again, an unusual drop in stocks. You really need to read it critically, and you need to separate out fact from opinion. I mean, there are times when I read things, including in the Wall Street Journal, that are very helpful to me, and they give me a new way to look at things. I mentioned Deere & Company. I think I first kind of focused on that company based on something that I read in the Wall Street Journal, but I didn't go run out and buy it. In fact, I still haven't bought shares of the company. I don't know that I will. But it got me sort of focused on that company, and I've started to evaluate it and look at it. So, there are things you can learn from things like the Wall Street Journal, but you really got to read it carefully, because I think it can cause you to really question yourself, question the market. As a rule for me, I don't make investing decisions on the performance of the market. I certainly look at things that I think are undervalued or overvalued and make investing decisions. I'll give you an example. This past year, Apple had fallen from a high of about a little over $700 down to, it was actually in the 300s earlier this year. And I bought more stock in Apple. I think I bought it at like $395. Now, when I bought it, it wasn't because I thought it was going to go up this year. I had no idea what the stock was going to do this year. And in fact, for all that matter, it could have gone further down. I didn't know. But I thought it was undervalued. I thought $395 a share for Apple was really cheap. How? Based on two things: based on its earnings, what it's earned, what I think it's going to continue to earn, and its balance sheet. It just holds a ton of cash. It's got an incredible balance sheet, and now I could look at what the market's done since then. It's in the mid 500s, and I could kind of look at that. I made a good quote unquote bet, right? And I've made some money on the investment. But the reality is, it could go back down into the 300s or lower. I have no idea where it's going to go this year. But based on its fundamentals, based on its financial statements, its earnings, its balance sheet, its place in the market, its brand, I'm very comfortable with that investment. Am I guaranteed to do well? No, absolutely not. But I think it's a reasonable decision. It gives me a reasonable chance of increasing the purchasing power of the capital I've invested in the company. So one last thing before we bring this episode to a close, and it's this. You hear people say that the more investing experience you have, the more likely you are, to avoid buying high and selling low. And I think there's some truth to that. Certainly if you lived through and were investing in the 08, 09 time when the market was down, and you didn't, out of fear, run and sell your investments, and you just stuck to your plan through 08 and 09, it tells you a lot about yourself. And the same is true if you stick to your plan through 2013 and now into 2014. Now the market's up. Do you stick to your plan when the market's up? But I will caution you to one thing that I found true about myself, and I've been able to stick to our asset allocation plan for a very, very long time. And the experience is certainly helpful, but there's actually one aspect in all of this that makes it harder. And that is that the longer you invest, the more you have. It's one thing to stick to an asset allocation plan when you've got $10,000 in your account, and if the market's down 40%, you've lost $4,000. Now try sticking to that plan when you have $100,000 in your account, or $500,000, or $1 million. Are you going to stick to your plan when you've got $1 million in your portfolio and the stock market's down 40%? Now you're looking at a loss of $400,000, and it takes on a whole new meaning. So I think experience is helpful, but we ought not ever let our guard down, because investing ain't easy. It's just not. Investing's not for sissies. We've got to know our plan. We got to stick to it. It may get easier in some respects as we have experience, but it's also going to get harder in others. So, again, what we've got planned, I'm going to have Larry Swedroe on the show tomorrow, and then the following day we're going to dive right into it, and I'm going to be talking very specifically about how to develop an asset allocation plan. I'm going to show you what mine is. I don't think that's right for you, but at least give you an idea. I think you have a right to know how I invest my money. If you've taken the time and been gracious enough to listen to this podcast, you ought to know how I invest my money. But more importantly, I'm going to talk about asset allocation plans and how you can develop one that works for you. That will be in 2 days. And then the following day, we're going to actually take an asset allocation plan and walk through how you would pick mutual funds. So it's going to get very detailed, walk you right through it. Hopefully it'll help you with your investing, with your planning, and with your saving for your future. So with that, as always, you can get the show notes to this podcast. Just go to DoughRoller.net/podcast23. You can leave me a voicemail. Go to speakpipe.com/DoughRoller. Love to get your questions and comments. You can email me at dr@DoughRoller.net. I read every email. I've been getting a ton of them, and I love it. I respond to every email. You can subscribe to this podcast. Just go to DoughRoller.net/iTunes. It will redirect you to the iTunes page where this podcast resides. You can subscribe there and also leave a review. And lastly, you can subscribe to our newsletter, DoughRoller.net/newsletter. It goes out every Saturday, packed full of resources and tips to help you make the most of your money. So until next time, remember, the best thing money can buy is financial freedom.